Michael Saylor, Why Traditional Investing is Dead, the New Rules. When Michael Saylor walked into a room full of Wall Street's most powerful investors and told them everything they knew about investing was obsolete, the silence was deafening. I'm sitting in his Washington, D.C. office, and the chart he just pulled up makes every finance textbook ever written look like ancient history. The 60 to 40 portfolio, he says, his voice carrying a mix of disbelief and certainty. Bonds and stocks. That's what they teach at Harvard, at Wharton, at every business school in America. And it's completely dead. It died in 2022, but most people are still following the corpse. The conviction in his eyes isn't theory. It's the look of someone who's watched the old rules fail in real time and rebuilt an entirely new framework from the wreckage. Saylor leans back, pulling up a graph that tracks a traditional 60 to 40 portfolio over the past 3 years. The line plummets in 2022, down 18%, the worst performance since the 1970s. For 40 years, this strategy worked, he explains, his finger tracing the historical returns. When stocks went down, bonds went up. Perfect balance. Perfect diversification. Except it was built on one critical assumption, that bonds and stocks move inversely. He pauses, letting the tension build. That assumption just died. In 2022, both crashed simultaneously. Stocks fell 20%. Bonds fell 15%. The entire foundation of modern portfolio theory collapsed in 12 months. The implications are catastrophic for anyone still following traditional investment advice. But what's truly striking is when Saylor discovered the old rules had broken permanently. It was March 2020, the pandemic crash. The Federal Reserve responded by printing $3 trillion in 3 months and cutting rates to zero. That's when I knew we'd entered a new paradigm, he recalls, the memory still vivid. They weren't following economic rules anymore. They were following political necessity. And political necessity means infinite money printing, which means everything we thought we knew about investing just became irrelevant. He shows me the monetary expansion charts. In 6 months, the Fed expanded its balance sheet more than in the previous century combined. The rules didn't bend. They shattered completely. This is exactly where the picture changed for Saylor's entire investment philosophy. Traditional investing was built for a world of sound money, he explains, standing up and pacing with barely contained intensity. A world where currencies held value, where bond provided real returns, where saving was rewarded. That world ended in 1971, when Nixon closed the gold window. But it took 50 years for the consequences to fully manifest. He pulls up inflation charts showing the divergence between official CPI and real purchasing power. They tell you inflation is 3%, but housing is up 40% in 3 years. Healthcare up 30%. Education up 25%. Energy spiking. Food spiking. The official numbers are statistical fiction designed to hide the truth. Your money is dying faster than ever. Wait a second. Don't miss this critical insight that changes everything. The first new rule, Saylor states, his voice taking on commanding authority, is that cash is trash. Not an opinion, a mathematical certainty. He shows me calculations that are devastating in their simplicity. At 15% real inflation, which Saylor argues is closer to reality than the official 3%, $100,000 in cash becomes worth $50,000 in purchasing power in just 5 years. Every single day you hold cash, you're losing wealth, he continues. The traditional advice was to keep 6 months of expenses in cash for emergencies. That advice will bankrupt you. The new rule, keep 1 month maximum. Convert everything else to assets immediately. The phone rings suddenly, breaking the intensity. Saylor glances at the screen, and his expression sharpens. I need to take this, he says, stepping into an adjacent conference room. Through the glass, I watch him speaking rapidly, gesturing at invisible charts in the air. When he returns 90 seconds later, his face carries satisfaction mixed with urgency. That was our CFO, he explains. We just converted another $200 million from our credit facility into Bitcoin. We do this constantly. Every dollar that enters our treasury gets converted to Bitcoin within days. Because every day we hold dollars is a day we lose purchasing power. Most companies hoard cash. Saylor treats it like toxic waste that must be disposed of immediately. You haven't seen Michael Saylor's most radical new rule yet. Rule number 2, he states, pulling up a comparison matrix. Bonds are obsolete. Completely, totally, permanently obsolete. The traditional thinking was that bonds provided safety and income. Saylor's analysis destroys this assumption. Let's do the math. A 10-year Treasury yields 4.5% today. Sounds reasonable until you factor in 15% real inflation. That's negative 10.5% real return annually. You're guaranteed to lose purchasing power every single year. He shows me a chart projecting bond returns versus real inflation over 10 years. The wealth destruction is catastrophic. Bonds made sense when inflation was 2% and yields were 6%. You got real positive returns. Today, bonds are wealth confiscation devices. The government borrows your money and repays you with debased currency. But there was one detail that made Saylor completely abandon traditional diversification strategy. In 2022, he watched clients with traditional balanced portfolios get destroyed. They thought they were safe, he recalls, the irony sharp in his voice. 60% stocks, 40% bonds, diversified across asset classes, and they lost 18% in a single year despite following every rule in the textbook. The problem wasn't their execution. The problem was the rules themselves no longer applied to reality. When both stocks and bonds fall together, when the fundamental negative correlation breaks, the entire premise of balanced portfolios collapses. You're not diversified. You're just diluted across multiple losing positions. Everything so far was preparation for Saylor's complete reimagining of portfolio construction. The new rules require a new framework, he explains, pulling up what he calls a 21st century portfolio. Instead of 60 to 40 stocks and bonds, I propose 90 to 10, 90% hard assets, 10% cash or liquidity. The hard assets bucket is where traditional thinking dies completely. Within that 90%, you need assets with specific characteristics. Saylor continues his intensity building, absolute scarcity, digital portability, divisibility, verifiability, resistance to confiscation, immunity to debasement. He ticks off each requirement like a mathematical proof. Only one asset class scores perfectly on all dimensions: Bitcoin. Everything else is compromise. Hard to believe, but Saylor argues that even stocks, the cornerstone of traditional investing, are fatally flawed in the new paradigm. Don't misunderstand me, he clarifies. Stocks are better than bonds or cash. But equities have a fatal weakness: dilution. He shows me data on share count inflation. The average S&P 500 company increases its share count by 2% annually through stock-based compensation, acquisitions, and secondary offerings. That's inflation at the corporate level. You need the company to grow earnings faster than they dilute shares just to break even. The math is brutal. If a company grows earnings 5% but dilutes shares 3%, you only capture 2% real return before factoring in monetary inflation. This brings us to rule number 3, which Saylor considers the most important. Own assets that cannot be debased, he states with absolute conviction. This eliminates most traditional investments immediately. Real estate, property taxes inflate with currency debasement. Maintenance costs rise. Geographic risk is concentrated. Gold? Better, but central banks hold massive reserves they can dump on markets. Industrial commodities? Subject to demand fluctuations. Bitcoin is the only asset with provably fixed supply, Saylor explains. 21 million coins. Not one more. Ever. No government can print it. No corporation can dilute it. No central bank can manipulate it. It's the first asset in human history with perfect mathematical, verifiable scarcity. But what's truly striking is how Saylor thinks about risk in this new paradigm. Traditional finance teaches that volatility equals risk, he says, pulling up modern portfolio theory charts. They measure risk as standard deviation of returns. Under that framework, Bitcoin looks insanely risky. 80% drawdowns. Massive volatility. But that's measuring the wrong thing. He advances to the next slide, showing purchasing power preservation over time. Real risk isn't volatility. Real risk is permanent loss of purchasing power. And by that measure, cash and bonds are the riskiest assets on earth. They guarantee you lose purchasing power. Bitcoin volatility is short-term noise. Its long-term trajectory is up and to the right in purchasing power terms. Wait a second. Don't miss this connection between the death of traditional investing and the rise of what Saylor calls digital property rights. The old rules were designed for analog assets, he explains, his voice taking on philosophical depth. Property that could be seized, inflated, taxed, or confiscated. The new rules require digital assets that exist outside traditional control systems. He shows me the evolution of property rights through history. Physical gold controlled by kings. Land controlled by governments. Stocks controlled by corporations. Bitcoin is the first property that exists purely in cyberspace, secure by cryptography and mathematics, not by legal systems or physical force. That's why traditional investors can't understand it. It doesn't fit their mental models. The phone rings again. This time, Saylor answers immediately, his expression intense. Buy it, he says simply, then disconnects. Another $150 million Bitcoin purchase, he explains without emotion. MicroStrategy now holds over 150,000 Bitcoin. We're not stopping, because every traditional asset in our portfolio is a melting ice cube. Every Bitcoin we add is purchasing power locked in digital stone. The strategy is relentless. Use every dollar of cash flow, every credit facility, every financial instrument available to convert dollars into Bitcoin as fast as legally possible. The traditional playbook says this is reckless concentration. The new rules say it's the only rational strategy. You haven't seen the full implications of rule number 4 yet. Leverage is no longer optional, Saylor states, and the claim seems to contradict every traditional warning about debt. But here's the key, he continues. You're not leveraging to speculate. You're leveraging to escape. Traditional advice says avoid debt. The new rule says use debt strategically to convert depreciating currency into appreciating assets. MicroStrategy has raised billions through convertible bonds at 0% to 2% interest rates. I'm borrowing dollars at 2%, which after inflation is negative 13% real cost. Saylor explains. Then I convert those dollars into Bitcoin, which appreciates at double-digit rates. The debt gets inflated away while the asset appreciates. That's not risk. That's arbitrage. But there was one moment when this strategy was tested to its limits. In 2022, when Bitcoin crashed from $69,000 to $16,000, MicroStrategy's debt triggered margin concerns. Critics predicted bankruptcy. That was a test, Saylor recalls, his voice steady. Could I hold through unrealized losses of $3 billion? Could I maintain conviction when every traditional investor was saying, I told you so? His response was to buy more. I understood something they didn't. The debt was dollar-denominated. The asset was Bitcoin. As long as I could service the debt in dollars, which we could easily, the temporary drawdown was irrelevant. And I knew Bitcoin would recover because of fundamentals, the death of traditional investing. That was only accelerating. Everything so far points to rule number 5, which Saylor considers the ultimate rule for the new paradigm. Think in decades, not days, he states, his conviction absolute. Traditional investing was quarterly results, annual returns, concentrating. The new rules require generational thinking. He shows me Bitcoin's 4-year halving cycles. Every 4 years, Bitcoin's supply inflation rate cuts in half. The pattern is mathematical, predictable. After each halving, a bull market. After each bull market, a bear market crash. After each crash, a higher low. The cycle repeats, but the long-term trajectory is exponential growth against fiat currency. The traditional investor sees volatility and runs. The new investor sees cycles and accumulates. This is exactly where Saylor's message becomes most urgent. Traditional investing is dead because the system it was built for is dead, he explains, standing at the window overlooking Washington, D.C. We're not in a normal economic environment. We're in the terminal phase of a 53-year experiment with pure fiat currency. And the experiment is failing catastrophically. The evidence is overwhelming. Government debt exceeding $36 trillion. Unfunded liabilities, over $200 trillion. Monetary expansion at unprecedented rates. The old rules assumed fiscal responsibility. The new reality is fiscal insanity. And insanity requires completely different rules for survival. The final new rule Saylor offers is perhaps the most controversial. Exit the traditional financial system entirely, he states. Not partially, not gradually, completely. This means rejecting bonds, minimizing cash, avoiding long-term bank deposits, anything denominated in dying currency. The system is designed to confiscate your wealth through inflation, taxation, and financial repression. Saylor warns, every dollar you keep in the system is a dollar they can devalue, freeze, or seize. The new rule is self-custody of hard assets, particularly Bitcoin, where you control the private keys and no institution stands between you and your wealth. Everyone thought traditional investing was safe, diversified, and time-tested. But the real story is that safety was an illusion built on temporary monetary stability. I'm not saying these things to be provocative, Saylor concludes, his voice carrying absolute certainty. I'm saying them because I've studied monetary history, modeled the mathematics, and positioned billions accordingly. Traditional investing is dead because the monetary system it depended on is dying. The new rules aren't optional. They're survival. And those who cling to the old rules will watch their wealth evaporate, while those who adapt will capture the greatest wealth transfer in human history. The choice is simple. Follow the corpse of traditional investing into oblivion, or embrace the new rules and position for the future. But the window is closing, and the old world isn't coming back.